Good afternoon. This is Howard Sorkin of DePaul University, and I am doing the capstone case study program. This is Chapter 10 of the textbook on investment planning, and this is being recorded, and it's going to be a summary with some highlights. Obviously, in investment planning, what we're trying to do is get our financial planners to be thinking about how to help their clients in the area of investments. Now that may sound like an easy task, but it does get a little complicated when you have to factor in the honest situation that most people spend less time planning their retirement and their investments in their 401k than they spend taking care of fantasy football or their vacation, and that many people don't understand the intricacies and or the additional information required even for some basic asset allocation. So financial planning is obviously dealing in terms of investments with probabilities, and we're trying to come up with our best guesses. No one has a crystal ball as to where the market is going to close on any given day, so certainly you cannot come up with any crystal ball on where it will be when you need the money in 3 years, 5 years, or 30 or 40 years of retirement. And retirement, as we've learned, is different today than it was for our parents and grandparents, in that in many cases what we're finding out about retirement is we have to plan entirely differently because we're living longer. So the financial planner has to be familiar with explaining in simple language that these are guesses, and what we're trying to do is come up with the best possible solutions, taking into consideration we don't have a crystal ball and cannot totally figure out the market. The financial planner has to understand that success or failure means people will be able or will not be able to pay their bills, so we really need to focus in on under-promising and hopefully delivering a better return. The financial planner has to realize that some of the situations, such as the overall economy, you can't control. What's going to happen in the world of politics, we can't control. Inflation, we can't control, or deflation. We have to come up with some solutions and be willing to monitor and pay attention to what these opportunities will be. You have to start with the client's current situation and their goals and their stages, and they may have money that they're not going to be touching for 30 years or 20 years, which can be invested differently than money that they may need as liquid cash, even for an emergency fund, or money that they may need for their children's education. And this should be, as part of the planning process and as part of the analysis that you're doing, in taking into consideration the client's knowledge of investments, the different kinds of investments, their experience, their expectations, and their risk tolerance. And be aware of the fact that when you're dealing with Jack and Jill clients, you might also find out very quickly that they have different philosophies and different risk tolerance, so many times you have to blend that. And what I try to do when I'm blending it is always go to the more conservative investor. The first step is to analyze their current situation. As I've said, I'm now on slide 7, and you can again study these at your own pace. Risk tolerance, slide 8, is very important because that's going to give you some indication, but it won't be perfect, as to where you should be looking for the investments for your client. The old adage that the more risk you're willing to take, the greater reward you should be willing and seeking, but the more risk you're willing to take also means on the downside, the more losses you're willing to take. And many people say, oh yeah, I'm a risk taker, until they have to start taking losses, and many people will find that as they're getting closer to retirement, their appetite for risk lessons. Many people will find that once they retire, even if they were high risk and a professional trader, there's a whole slew of money that they want to try to take off the table. Your job as a planner is to manage the expectations and be realistic about what you can do. And that's an important factor to consider, that the plan should be tempered by the client's expectations and be satisfied with the current expectations and what the plan says, but you have to build in some flexibility. Slide number 10, time horizons, as I've said earlier. The earlier you start, usually the more risk you're willing to take and the most growth-oriented. If you're not starting until age 50, you're going to have to play catch-up and put away more money. PowerPoint slide 12, what is your capacity for risk? And again, that's something you have to study and be aware of. And don't be afraid to break the money into different pots and say, if we're not touching it for 30 years, we can take a little more risk. But again, as people are retiring and getting closer to retirement, they usually become more conservative with most of their money. There are different asset allocation questionnaires that almost every broker-dealer and financial planning software package has, and you can get them. A lot of them are using the Ibbotson studies for time horizon and risk tolerance. What is the required rate of return that the client wants? Well, here's where you as a planner have to come in with some ideas and guide them, because everyone wants no taxes, the highest rate of return, the highest amount of income they can get with no risk. There's no such investment, there's no such combination of investments. So you have to be able to manage expectations, and sometimes in today's world, go back to the risk-free rate of return of a treasury bill or treasury bond, even though it's very low here in 2014. If with taking no risk or very little risk, you can get 3%, everything above that is going to be riskier, and people have to understand it. They also have to understand that leaving money in CDs is not necessarily risk-free rate of return, because it will not keep pace with inflation or let you maintain your purchasing or buying power. To determine the client's expectations on how to allocate, that's where you're going to come in, and you may have to come up with several different alternatives and some different game plans on those allocations. Slide number 15, the planner must not only consider the asset classes, but the specific factors and economic factors when allocating for those asset classes, such as the client's goals, objectives, how much liquidity they need, what their total asset breakdown is, and how aggressive that portfolio should be. Stocks are usually classified into three categories. Large cap, which would be over $10 billion of capitalization. Mid cap is between $2 and $10 billion of capitalization. Small cap would be under $2 billion. Today that can even be broken down into super large caps or very small caps or micro caps, and be aware that you will probably have to explain what that means to your client. People think that bonds are risk-free, but bonds are not risk-free, and there is an inverse relationship between yield and the actual price of the bond. The primary purpose of debt instruments is to provide income, and bonds typically pay an interest rate on a regular basis, could be monthly, usually quarterly or semi-annually, and the secondary purpose is capital appreciation. But when you're investing for fixed income, the primary purpose is income, not capital appreciation. When we look at different classifications, you have treasuries, which are and/or governmental agencies. Treasuries, up until recently, were always AAA rated, because until the downgrade after the financial crisis, everyone said the U.S. government doesn't default on its debt, pays its debt, and there's no risk involved. Please make sure you understand the difference between a treasury bill, which is short-term under a year, frequently traded through major banks. Treasury notes, typically 1 year to 10 years. Anything longer than treasury notes would be treasury bonds of longer than 10 years. Municipal bonds, you may have to be able to do the computation to determine the difference between the municipal rate of return and then factor in, if you were paying taxes, what the actual rate of return would be. Corporate bonds are issued by public corporations. In some cases, corporate bonds are AAA rated. In other cases, they may be junk bonds or very lowly rated. The higher the rating of bonds, the lower the return or the yield. The lower the rating, the higher the return, because you're taking more risk. In terms of duration, the longer you go out on the yield chart or yield curve, the greater the risk something's going to happen. Therefore, you're going to get in a normal yield market, you're going to get a higher rate of return. Zero coupon bonds are sold at deep discounts to par value. They do not pay periodic yield. You get it at the end. There are international bonds. There are emerging market bonds. All of these are different instruments, and you should be able to explain it. Another category is commodities. That's called alternatives today. Commodities can be traded on any one of the major exchanges in the United States or elsewhere, or they could be traded off exchanges, such as some of the energy products that are very popular today in interest rate swaps. Main categories would be precious metals, gold, silver, palladium, platinum. Natural resources, that's where you would have primarily energy, oil, gas, and energy products. Livestock, which would be cattle, pigs, and agricultural products, corn, soybeans, wheat. And then in addition to that, you have financial futures, you have stock indices, and other kinds of things that are classified as alternatives and commodities. Real estate is an investment asset class. I'm on slide number 19. Real estate is to provide income as an investment. We're not talking about the real estate that your clients live in. We're talking about investment real estate. Many times these are real estate investment trusts called REITs, and they typically pay dividends on a monthly or quarterly basis, and you buy that for yield, and you also buy that for some appreciation. But the primary purpose of real estate is yield. Sometimes you will buy raw land or agricultural land, and then there are the major categories, which would be commercial real estate, residential real estate, shopping center real estate. It could be hospitality real estate, so forth, and industrial, which would be the big warehouse areas. And then there's also real estate where some people are just investing in the mortgage-backed certificates. Slide 20. Remember that the idea that value at risk, what does that really mean? Is the relationship between how much money the client has invested at a given point of time in the future and how much the client initially invested. How much capital is at risk and how much money have they made with that risk. And it says the level of risk did not increase or decrease during the period, i.e., if the client originally invested $100,000 and the portfolio was still worth $100,000, there's no change. If, on the other hand, the client invested $100,000 and it's worth $60,000, they've lost principal. If it's worth $140,000, they've gained principal. And that's what. And then again, depending on the time horizon and the amount of risk you want to take, will determine what you're looking for. And make sure you understand as a planner the difference between investing for income and investing for growth. And when we're talking about growth, depending on how the portfolio is constructed, you may be looking at value investing or growth investing. We'll discuss that shortly. The planner should consider the current and prospective economic environment when changing asset allocation models. Don't just churn the account. Don't just go from one large cap growth account fund to another large cap growth mutual fund or ETF. That's not doing your client much good if they're invested in the same thing. But if one fund is really doing poorly, it's your job to do that analysis. Be aware of what it means when the US dollar rises or falls in relation to other currency. Be aware of what is the growth rate worldwide versus the growth rate just in the United States. Slide number 23. Are we going to be in one asset class or multiple asset classes? That is for the planner to determine how we want to allocate the money. And it says some academicians and planners argue that clients and planners tend to use mental accounts to separate assets on different purposes. Sometimes clients that have a lot of liquid cash will just say, I'm allocating this as an emergency fund, but they're not classifying it as an emergency fund. Analyzing the client situation, you look at all of their accounts. You may want to look at them in different categories such as 401k or IRA, or you may want to just lump them together. That's how you're looking at things. The financial planning life cycle is typically set as protection, accumulation, and distribution. And one of the things people have to understand is as they're getting into the distribution phase, they're going to be investing differently and looking at different things. Distribution phase would be anyone getting into the retirement planning phase. Life cycle planning, during your younger ages, you're into protection, you should have an emergency fund. During the accumulation stage, which is anywhere from 20 to 40 years, you're building wealth. The distribution phase, you're living off the wealth you built, and you may want to have a legacy planning phase as part of how you're going to dispose of your wealth if you die. Slide number 27. Determine the client's investment profile, their risk tolerance, how much knowledge and experience they have, and many times they're going to either tell you they have none or they have a lot, and you better figure out what they really have, especially if they have to explain things to them. What is their capacity for risk? What is their appetite for risk? And people will say, I'm willing to take risk, but you better probe at that. I was dealing with someone one time who kept telling me that she loves to go to Las Vegas and she really enjoys gambling and everything else. And after a 10 or 15 minute conversation, what I was able to find out is she goes to Las Vegas, but she spends all the time at the nickel slot machines, and if she loses $50 during her entire trip, she's lost all the money she's willing to spend. Unfortunately, the previous broker had her into all kinds of more aggressive funds at the age of 78 than she ever should have been in, because she really wasn't a risk taker. Her idea of gambling was taking her kids on a vacation, and as I said, she would be willing to risk $50. Slide number 28. Pay attention to the fact that clients typically have more than one goal, more than one time horizon, and you may need different strategies to accomplish this. Pay attention to the fact that attitudes and expectations will differ, especially between husband and wife. Some people are very into social responsible investing, and that's fine for them. That means you shouldn't be recommending alcohol or tobacco products. Some people will tell you that they believe very firmly in certain things, and regarding their religion or their political beliefs, be very careful how you invest, because you have to have the investment policy statement and their goals in line with what their beliefs and values are. Slide 29 has a little questionnaire. Keeping pace with inflation is important to me. Either agree, disagree, neutral. This is a sample of a kind of questionnaire. I tend to use one that has a little more detail on it and just take care of it that way, but that's not a bad questionnaire. It's slide 29. Comparing the client's investment portfolio, pay attention to where they're at now in relationship to where their risk tolerance is, their time horizon is, and make your determination. If you're making changes, make sure you document why you're making changes and what it has to look like. It says here that if you're more than 10 years out, you might want to either be aggressive if they have a high tolerance for risk, or moderate if they have a low tolerance for risk. This is a pretty good chart to give you an indication on slide number 31 of where they should be looking for their investment return. We have to understand that portfolios have to be benchmarked against certain standards, and many times today they're going to be using the S&P 500 or the European index or a bond index, and make sure that you pay attention and you understand how people are going to be looking at things and what they're going to be measuring them by. You can't just go and say, well, we did 20%. If the overall market was up 40%, you didn't keep pace with the market. If on the other hand, you lost 20%, but the market itself lost 39%, you did beat the market. So make sure you understand how to explain the benchmarks. There are certain common investment statistics and calculations you're going to have to be aware of, and there are going to be certain ratios you're going to have to be able to compute for the comprehensive exam. And not all clients are necessarily interested in how to figure out these calculations. It says some compensation is required in exchange for delaying the opportunity to spend money. If I'm putting money away, I want some growth or something to say, why am I delaying the satisfaction of spending the money? And I'm going to tell you, in the real world, what I have learned is there's a perfect correlation between short-term memory loss or selective memory and people losing money. So make sure when you're doing your financial plan and you're doing your investment portfolio statement and your guidelines that you document, and document. The next several slides deal with different ratios. The Sharpe ratio. Go back to your book and refer and understand there are certain ratios that will measure rates of return, risk-free rate of return, standard deviation, and you're going to be required to do some computations on the exam. You can refer to your textbook or go back to the investment textbook to make sure you understand how to do these measurements and these performance ratios. The Sharpe ratio is one of two performance measures used to determine the risk-adjusted performance of a portfolio. Sharpe is risk-adjusted rate of return. And the Magalani measurement is another measurement for rate of return. The Trainer Index, somewhere along the line, a couple of these you're going to be required to compute. I can't tell you what is going to be on your exam. It could be the Sharpe, it could be the Trainer, it could be the Magdaleni, which I think isn't probably the one they're going to use, but I have no way of knowing. The Trainer Index measures the standardized risk-adjusted performance, but instead of using standard deviation, it's using volatility and using beta. And make sure you understand what these terms mean. Jensen, or the alpha ratio, slide number 40, is an information ratio. And be aware of, again, alpha, beta, gamma. Understand how to at least explain it. Because on the comprehensive exam, the assumption is going to be made that you can explain these to a client in simple language, and you may have to compute some of the formulas with your calculator. Clients tend to seek the help of financial planners for investment planning and guidance because they want to increase their return, they want to increase their income, they want to reduce their taxes, and they need help and guidance. Even though people have master's degrees and MBAs today, they don't have the time to do it, and that's why planners need to understand how to do it and get it done. And it says identifying the investment management strategies. Due to the wide variety of products available, there are equally diverse number of strategies that you might be looking at. There are some people that want to do the investments on their own. There are other planners that want to outsource that. Those are decisions you have to make of how you want to have your business model. Slide number 44, and for a whole group of slides after that, it's going to be talking about the different kinds of products and strategies to use. It says, use zero coupon bonds in anticipating changes in interest rates. Years ago, when my children were younger, I could buy a zero coupon bond, a zero coupon municipal bond paying 9, 10, or 11%. And if I would buy that bond and let it mature, there was a lot of money available in 10 years or 15 years for college. And if it was a municipal bond, I never paid any income tax on it. On the other hand, if I bought a zero coupon corporate bond, each year I had to declare the taxes and pay taxes. Did I know how to do that? Was I aware of how to do that? Was I aware of the differences? That's what you as a planner have to be able to explain. It's what does duration of a bond mean? Well, the longer the duration, the more risk you should be taking, because the longer you go out on that yield curve, the longer the money's at risk. But if you're taking more risk in a normal environment, you want to get a greater rate of return. Why are you going to use REITs? And are you going to use publicly traded REITs or non-traded REITs? What are you going to be doing? Do you understand why you would be writing covered calls and how that could increase the yield of a portfolio? Increasing the portfolio by reducing the mix or the quality, or increasing the quality of the mix of the portfolio bonds. And you should be always cognizant of taxes, because your clients are going to be cognizant of taxes. It's not what you make, it's what you keep. Slide number 45, decreased tax liability. You might want to use annuities, even though some people like them, other people hate them. What is certain ways of hedging inflation risk and income risk? What about using hard assets? What do those mean? How do you manage and allocate for long and short-term gains, both for taxes? How do you harvest tax losses? These are all things that you might be confronted with and things that you might have to look into and make sure you understand. Slide number 48 under supplemental topics. What is a treasury bill? And it says here the risk-free rate. The treasury bill the T-bill is often quoted as a risk-free rate. Why is that? It's because it's liquid and the government doesn't default on it, and therefore that is investing in something that should provide you with a return without any risk of not getting your principal back. But is there such a thing as a risk-free rate of return? Because it says here that it's quoted at a nominal rate and thus it's impacted by inflation, and you're holding it for a short period of time, so inflation on a treasury bill probably isn't going to have a negative impact on your buying power, because usually treasury bills are anywhere from, they're quoted in 90-day increments, but on the aftermarket you can usually buy them down to a day or a week. What does modern portfolio theory mean, and what does Markowitz's theories mean? Be aware of this, because it might be tested where you just need the information. There's a thing called systematic risk and unsystematic risk. And sometimes people just need to understand it and be aware of what these terms are. Systematic risk, called market risk, is embedded in the system of financial markets. It says we're going to take care of everything in the market. Political risk, regulatory risk, volatility risk, it's all built into the market. And it says it cannot be eliminated through diversification. Unsystematic risk or firm risk is a type of risk that can be managed and reduced through diversification. So systemic risk or systematic risk is the entire market, and that's what they kept talking about in the downfall of 07, 08, 09, is everything in the market was at risk. But sometimes using unsystematic risk, we can diversify and lessen the amount of risk the investor takes. I don't know if you're going to actually have to figure out these statistics and do the math for the comprehensive exam, but you may have to. So just review this on your own. Again, the Sharpe ratio, the Trenner ratio, the Mogadolano ratio, I've never been able to pronounce that properly. Understand what the coefficient variation is. Understand what the word covariance means and what that is going to do. Again, this is just a summary. Standard deviation. Quite frankly, on my comprehensive exam, I had to compute standard deviation, but I had done so many practice problems, and I've said this in many classes, I didn't even compute it. All I had to do was look at the question, and it was, because of all the practice problems, I already knew the answer. I'm going to try to move over a little. Standard deviation. Risk can be quantified using measures of volatility. Standard deviation is a measure of the historical returns that are dispersed around the average. And it says 68% of all observations fall within one standard deviation, and 95 are within two, and within three you have 99% of all probability. So what you really want to remember is the lower your standard deviation and the higher your return, the more efficient your portfolio is, because you're taking less risk for the same return. I don't know how technical some of these questions are going to be. Be aware of what CAPM is. The formula used to calculate the expected return is known as CAPM, or Capital Asset Pricing Model. This was also on my comprehensive exam, as was, I believe, the trainer and the Sharpe index and standard deviation. Those were the ones I had to compute. What's beta? Beta is a relative measure of risk and is most often used as a measurement of systematic risk in the stock market. So if the whole market is 1 and your investment portfolio is at 1.34, you're taking 0.34 basis points more risk for the same return, or 0.34 basis points more risk than the standard market. Therefore, you should be getting a better return. If, on the other hand, under beta, your portfolio is at 82%, that means you're taking less risk. And if you're taking less risk and get the same return, you're actually doing better. It's because it says here, by definition, on slide number 70, the beta of the overall market is 1.00. And slide 70 explains what I just said. Planners who use beta should only do so with well-diversified portfolios. So if you're not in a well-diversified portfolio, do not necessarily keep referring to beta. The Trainer Index standardizes a portfolio return in excess of the risk-free rate of return. The Sharpe Index can be used to standardize the return of a portfolio in excess of the risk-free rate of return by using standard deviation. This is on slide 72. And if you want to have some ideas of disadvantages of various asset classes on slides 72, 3, and 4, that's what these are going to provide. So be aware and make sure you understand what managed funds are. Make sure you understand what index funds are, index mutual funds, exchange-traded funds, because people are going to ask you to explain that. This is the overview of chapter number 10 on investment planning. I hope it's been beneficial, and thank you very much for listening.